Today, we're looking at another essential participant in project finance transactions, the hedging bank. Project finance deals typically rely on long-term debt with floating interest rates and cash flows that need to be predictable over many years. This creates interest rate risk and sometimes currency risk that must be managed carefully. That's where hedging banks come in. So who qualifies as a hedging bank? Generally, this role is filled by senior lenders that have the capability to provide hedging instruments, such as interest rate swaps. Since senior lenders are already financing the project and are familiar with its risk profile, it's efficient and common for some of them to also act as counterparties for hedging arrangements. Very often, the original mandated lead arrangers are automatically included as hedging banks. This makes sense because they were involved from the outset in structuring the facility and understand the project's financial model, its cash flow assumptions, and its risk allocation. Beyond this initial group, other lenders, or their affiliates, may also participate in hedging, provided they meet a minimum rating requirement. This rating threshold exists to protect the project company and its other lenders. Since a hedging arrangement creates a long-term financial exposure, it's important that the hedging counterparty maintains sufficient creditworthiness throughout the life of the project. If a hedging bank's rating falls below the required threshold, this can trigger contractual consequences, such as a requirement to post collateral or to be replaced. Why does this matter in practice? Because the hedging arrangements are usually documented under the same finance documents and share the same security package as the senior debt. This means the rights and obligations of hedging banks are closely interconnected with those of the other senior lenders, particularly when it comes to enforcement, ranking, and intercreditor arrangements. Understanding who can act as a hedging bank and under what conditions helps you better anticipate how interest rate and currency risk will be managed throughout the life of a project, and how this affects the overall lending structure. If you found this summary useful, don't forget to like, subscribe, share this video with your colleagues and friends, and check the description below the video for useful information. Thanks for watching, and see you in the next episode.